The reporting period is an accounting principle. It's probably assessed a little more than some of the others. So let's lock in a definition and we'll say the ongoing life of the business is broken into periods of equal length. Remember, these periods can't be longer than 12 months. They can be a month, a quarter, half a year, or a year, but no longer than a year. And secondly, it's got this second part to the definition that a lot of people forget, and that is at the end of every one of these periods, we're going to match all revenues earned against expenses incurred, and that'll help us get our net profit. So this word here is really important. We're going to match revenues with expenses at the end of each period. That is part of the reporting period definition. So what it does is it sort of takes the principle about going concern, which assumes the business's life is infinite, and sort of makes that a bit more realistic. Okay, we assume the business is going to last forever. Does that mean we never do an income statement until we finally sell it? What if we own the business for 10 years? Well, that wouldn't work. So what we're actually going to do is break up this infinite life into little chunks, which we call reporting periods. Now they've got to be of equal size. And what we're going to do is at the end of each of these periods, we're going to match revenues and expenses to get profit. So after period 1, I take my revenues, less away my expenses, that gives me net profit. At the end of the second period, take my revenues, match with expenses, net profit, revenues, match with expenses, net profit, revenues, match with expenses, net profit. So that is all the reporting period helps us do. So let's take an example of some questions we might get sort of concerning this. Example 1, a business prepaid rent of $12,000 for the next 12 months. At the end of the current reporting period, there's 9 months of rent remaining. Explain why a balance day adjustment is required in this situation. We always identify with a theory question. I'm going to use the reporting period principle. I'm going to define it. Let's get the definition nice and tight. Cut out a lot of that stuff that we don't need. Let's just give the bits in blue and bolded and underlined. At the end of each reporting period, the firm's net profit must be calculated by matching all revenues and expenses. I haven't put in the bit about breaking the life of the business into periods of equal length. It's not really about that, this question. It didn't say last year they calculated their profit for 6 months. This year they're doing it for 4 months. So I've only given the part of the definition that's appropriate. Now I'm going to relate it and say in this case we need a balance day adjustment to record the amount of the rent that's being consumed this period, and that is going to be called an expense. Well, what's that got to do with the reporting period principle? Comes down to that word matching. What I'm now going to do with that expense is match it against all my revenues in order to calculate net profit for this period. Let's look at example 2. A business received $2,000 for goods to be provided next reporting period. So we would call that a prepaid revenue. It's been received but not yet earned. Explain whether this amount should be recorded as revenue for the current period. Identify the reporting period principle, define it, and then in this case my relate is going to be a little different. I'm going to say this is clearly not revenue. So whilst we've received it, it won't be earned until next reporting period. And what I should do then is only recognize it as an expense next period, as a revenue next period, and that way I'll be able to match it against the revenues for next period with the expenses, and I'll be able to get my net profit correct. If I counted it as revenue for this period, I'll be matching revenues for next period with expenses for this period, which doesn't make any sense.